Hello, everyone, and welcome to today's webinar, the new Form 941, Understanding the Changes to Your Quarterly Return. I'm Yonina Shineweather, CPA, the Consulting Director of Compliance at Viventium, and I'm really excited to be together with you today with this webinar because it's really a major change to the 941. And I just feel that there's so much information out there and so many changes that, somebody needs to be explaining this to the public. The IRS has done really a yeoman's job of keeping up with Congress and all the legislative changes that have come in the wake of COVID-19. But I just feel that there needs to be a lot more explanation of how to reconcile, how everything ties together, because until the 941, we've been doing a lot, talking about credits. Those of you who have been on Viventium's earlier COVID-19 webinars, we've heard about the FFCRA credits and the CARES changes, and of course, we've talked a lot about the PPP loans. But really, the litmus test as to how all of this is going to work and how companies are going to get their money back, are going to get credit for credits that they've taken but not yet actually received. It's now, it's a quarter end, and it's with the new Form 941. So just before we dig in and get started, just a couple of administrative points. First of all, today's webinar is being recorded, and both the slides and the recording will be made available to you. I know that's a question we usually get. Will we get a copy of the slides? In today's webinar, it's especially imperative because we're going to be doing a lot of number-intensive stuff. And in order to really fully get the benefit of it, you're going to want to go back over. We're going to be doing a case study, as you were promised in the advertisement of the webinar. We're going to work through actual numbers, and it'll really, I hope it'll be really helpful for you to use the Viventium case study and keep it as a model, because we're going to be doing a live 941 and filling it out and seeing how that's going to be started. So that's just an important side point. Another important point, and I see some of you are already taking advantage of it, is to please do use your question toolbar as we go along. There on your dashboard, you have an ability to ask questions. Again, those of you who do Viventium webinars a lot know that we always say if you have a question while you're listening, then probably other people do as well. And you'll be doing a big service to everybody by asking that question. And I do try to keep my eye on the questions as we go along. Just really off the topic, but I see since someone's asking the question, when will the Viventium forgiveness reports be released? It's going to be called the Forgiveness Suite, and I'm just happy to let you all know, those of you who are with Viventium, that is scheduled for release next week, which is very exciting. And we'll be communicating that, of course, to all of our clients and conducting training on that. But that's really off topic. But since that question was asked, and I do tell you I do pay attention to the questions, I wanted to answer that. And so with no further ado, let's jump in. When the webinar was named the new Form 941, there was some questioning, what should it be called? The revised form, the changed form, the modified form. But the changes are so great to this form that it really justifies the name, the new form. In 30 years, and I've been in payroll now 30 years, there have never been so many changes and such broad sweeping changes to things like the definition of taxable Social Security wage. It has just never happened in a single quarter, and I don't think there's been as many changes in 30 years cumulative. So it really is a new form, and what we're going to be looking at today, as you have in front of you on your slide, is first of all the new lines, lots of them that have been inserted into the form, and there's a brand new page. The form is now, the actual 941 is now 3 pages instead of 2, and then plus that we still have the Schedule B. So we have a brand new page. Then we're going to go into a little bit of a dictionary, the new 941 concepts dictionary, and just define some of those new concepts. We're going to go line by line through the form, and we're also going to understand the interplay between the 7200 and the 941, and a very big misconception and a mistake that I'm going to encourage you not to make and point out to you, and also for those of you who have already given in your 7200 information to your payroll providers, just to help you see how the 7200 and the 941 kind of coagulate together, and just to understand that. And then we're going to jump into, I think, probably the most important part of this webinar, which is a case study. A fictional company, Helpers from the Heart, a fictional home healthcare agency. We're going to work through their numbers, and they had all kinds of exciting things happen with their COVID-19 credits, and we're going to see how that actually plays out on the 941. And again, I'm going to encourage all of you, including those who have joined after I said it, to actually print out this case study when you'll get the copy of the slides, which you will after the webinar, and use it. Use it. Those of you who are with Viventium will use it to understand your Viventium returns. Those of you who may be doing this on your own or with a different provider, this will help you. It's a generic case study, and it will help you work through understanding your 941. So let's take a look, first of all, at the old versus the new. On the left-hand side, you have the first quarter 941, and on the right-hand side, at least the first page of it, on the right-hand side is the second and third and fourth quarter of 2020's 941. Now, when the IRS issued the 941 for 2020 back in 2019, they had no idea of what was going to be happening. None of us did. And so the first quarter of 2020 is a plain vanilla, straightforward 941, the way it looked in 2019, basically the way it looked in 2018, with all the lines that we're familiar with. Take a look at what happened in second quarter. So first of all, as you'll see, the little box up here where you indicate which quarter you're in, you see January, February, March is grayed out. That means if there are any of you who did not yet file your first quarter 941, you can't use this form. You have to go back and use a first quarter. This form is only good for April through December of 2020. What will happen in 2021, no one knows, but this form is to be used only for the second, third, and fourth quarter. So you can't go ahead and check off January through March. What if you need to amend a first quarter 941 for whatever reason? So presumably you would use the standard 941X. That's not such a problem. There's a bigger problem though. If you need to amend your second or third or fourth quarter 941, let's say you get your form from your service bureau, from your payroll provider, and for whatever reason there's a mistake on it and it's been filed already, what are you going to do? Well, right now, the answer is you're going to have to wait, because the IRS has not yet issued a 941X for the COVID-19 941, meaning the existing 941X only references the old form, the pre-COVID form. It does not have all of the additional changes of the new form, nor has the IRS really made any noise in that direction. We have not heard anything about a release of a 941X. I think right now they are just, they're basically, their resources are being directed toward keeping up with getting people a form to file right now. And again, I do want to stress they've done an excellent job in preparing a form on relatively short notice, and just getting everything incorporated into it. So if there are a couple rough edges, and there are a couple rough edges inevitably, we can forgive them for that. It's totally understandable. And one of the missing pieces is how are we going to amend this form? Where's the 941X? And we're hoping to hear more guidance from the IRS on that, in sometime in the third quarter. But for now, that's the situation. We do not yet have an amended form. What you see in red, or in the Viventium pink actually, are the new lines, 4 new lines on the first page. So we have a concept called qualified sick leave wage. That's new. And you see that gets multiplied. The wage gets multiplied by 6.2%. We'll define that soon when we go into our dictionary. There's something called qualified family leave wage. Some of you may be used to calling that child care leave, but that's a new line. And then at the bottom, 2 other new lines, something called a non-refundable credit for sick and family leave, and a non-refundable credit for the employee retention. So what is this non-refundable? That's what's new on the first page. We will be defining these soon. Let's move on to the second page. Now, in the old way, the first quarter 941, the top asked for your month-by-month liability, or if you were a semi-weekly depositor, you filled out form Schedule B. Okay, and then you signed and etc. Dated. Well, here's page 2 of the new form. The entire part 1 is new. This is all COVID related, so no point in highlighting anything there. It's all brand new. Non-refundable credits, taxes plus non-refundable credits, deposits, et cetera. We'll go through this line by line. So all of this, line 11D through line 14, is basically new. I mean, the balance due and overpayment obviously works the same way. And then part 2 down at the bottom corresponds to part 2 up at the top of the old form. That's where you're going to put in your month-by-month amount and indicate if you're semi-weekly and you're attaching Schedule B. So that's page 2. And then there's a brand new page. This did not exist. Of course, you see the bottom part is the signature and dating side of it. That's fine. But the top part is also quite new, most of it. I'm going to make it a little bigger so you can see it more conveniently on your screen. Lines 17 through 25 contains some old and some new. Most of it is new. Line 19, about the health plan expenses that go along with sick pay, or 20, the health plan expenses that go along with family leave. Line 21, wages for retention credit. We'll talk about what that means, also brand new. And qualified health plan expenses allocable to the wages for retention credit. And then lines 24 and 25, we have something that we have never, ever seen before on the 941, and that is crossing of quarters. Lines 24 and 25 contain first quarter wages that were used for the employee retention credit. Qualified wages paid after March 12th, but through the end of first quarter for the employee retention credit. Now, what is that? What are first quarter wages doing on the 941? And I just want to take a step back conceptually and just explain something very important. Some of you may be listening and maybe saying, well, you know what? I'm on a tax service. My payroll provider, whether it's Viventium or someone else, they do my taxes for me. So, I mean, it's very nice that she's going into all this line by line detail, but why do I have to do this? Or I didn't even take advantage of the COVID-19 credits. I didn't claim anything. Why is all this information important? So the answer is twofold. Number one, there is no COVID form and non-COVID form, meaning everyone, whether or not you used COVID credits, are filing the new 3-page form. And the second answer, which is the first question, so fine, so I'm filing it, but my payroll service is taking care of it for me. You need to be able to understand your forms, because ultimately, if there is any mistakes, any allocables that were allocated wrong, it's going to be you, the employer, that bears responsibility for it. The IRS is always very clear about that. The responsibility for filing, depositing, any penalties associated go to the employer, not to their third-party provider. And so it's really, really important that you have a handle on this information that your payroll services are providing you with, and that you are able to back it up and able to explain it if need be. So this is part 3, and we're going to take a look at this and try to understand what first quarter wages are doing on this form. But now I want to take a step into the dictionary, into the new 941 concepts, and define and explain them. Now, we just had a question here. Just want to pause a minute and again encourage everyone to use their question bar. And the question is, what if you are a nonprofit and exempt from disability, meaning the paid family leave, the sick leave, meaning exempt from having to pay any of the mandatory leave? Well, again, if you're not paying mandatory leave, mandatory FFCRA leave, or even if you're not exempt, but you just didn't have it, then you're going to show 0 for the FFCRA leave wages, but you may still have the employee retention credit under CARES. You may still have employer Social Security deferrals. So there may still be fields on the 941 that apply to you. So just to point that out. Okay, let's take a look now at these new concepts. So you might ask yourself, why is Viventium labeling, taxable Social Security wages as a new concept? I mean, we've been putting taxable Social Security wages on our 941, from as long as we can remember. The answer is that, unfortunately, and this maybe has not been stressed enough in various guidance, taxable Social Security wages on the 941 this quarter does not mean the same thing as taxable Social Security wages meant last quarter and the quarter before that and before that. Taxable Social Security wages, starting from now, means taxable Social Security wages minus any mandated FFCRA leave paid. any leave that you paid under the Families First FFCRA that mandated, whether it was for people out on sick, self-sick, or caring for others, whichever the limit, the first 3 reasons of FFCRA, the second 3 reasons. By the way, just as a by the way, and Viventium will be communicating this to our clients, the IRS has just announced that on the W-2 at year end, employers are required to report either in box 14 or in a separate statement, separately, the amount of FFCRA leave paid for the first 3 reasons on that list, which is what we call self-care, and separately, the FFCRA leave paid for the second set of 3 reasons, which is care of others or any similar reasons, as well as the child or family care. So that's just an interesting point. Of course, Viventium is supporting this for all of our clients. Those of you who are not with Viventium may want to take this new IRS announcement about W-2 reporting to your payroll providers and make sure that they are able to support that breakdown at the end of the year. But that was just an aside, not connected to the 941. So taxable Social Security wages, again, the definition is all your old-fashioned, everything you knew before about taxable Social Security wages, and then subtract out any leave that you paid under FFCRA starting from April 1st to your employees for sick leave or for family leave, the extended FMLA, the paid FMLA, or emergency FMLA as it's sometimes called. Some providers call it child care leave, lots of different names for it, but that is what is subtracted out, and the remainder, the difference, is what you're going to put on line 5A of your 941, and we will see this in our case study. We're going to be seeing how all this plays out. Now, what is qualified sick leave wages? Qualified sick leave wages is amounts that you paid starting from April 1st and that you were mandated to pay under FFCRA or that you elected to be voluntarily covered in the case of healthcare providers, and that were for any one of the 6 reasons, meaning it was paid to an employee because the employee was instructed by a healthcare provider to quarantine, or by a government order to quarantine, or the employee was experiencing COVID-19 symptoms and therefore they were waiting a diagnosis, or the other 3 reasons, they were caring for someone who was quarantined due to a government order or due to a health provider order. They were caring for a child for the first 2 weeks only, the first 10 days, whose place of education or daycare was closed down, or any substantially equivalent reason, which none have yet been issued, by the way. So all of those 6 reasons, if you paid your employees qualified sick leave wages, they are reported on line 5AI. I don't expect you to remember that. We're going to see it soon. But they're not included in the taxable Social Security wages line. Qualified family leave wages are if you paid those remaining 10 weeks, in other words, after you paid the first 2 weeks under the first provision, then you continued paying if an employee was taking care of a child whose school was closed or whose daycare was closed, and you paid them the extended FMLA or the emergency FMLA. Again, this is sometimes called qualified child care leave. That is the qualified family leave wages. And then the employee retention credit was a credit signed into law in the CARES Act on March 27th, and that allowed qualified employers who were experiencing COVID-19 slowdowns or shutdowns, and who kept their employees on payroll to claim a credit for 50% of the amount of wages that they paid to their employees. Now, of course, what wages qualify depends on your size. If you're under 100, you could count wages paid even if the employees were continuing to work. We had spoken about this in earlier webinars. I'm not going to go into too much detail now, but anyone who wants more information is invited to visit the Viventium webinar site for more information on the CARES Act. If you're above 100 employees, then you only get to claim that 50% wages credit for employees who are not working and that yet you're keeping them on payroll. And the credit was limited to a maximum of $10,000, not per quarter, $10,000 for the entire year per employee, which means a $5,000 credit, right? 50% of $10,000, $5,000 maximum credit per employee. Now, I'm going to leave these next 2 concepts, non-refundable and refundable credit, because they're the hardest and perhaps the most important, so I want to leave them for last. The deferred amount of employer share of Social Security tax, that's a line on your 941 now, and as we know, the CARES Act allowed you to defer your share, your employer's amount of Social Security tax, with half of it to be paid at the end of 2021 and half of it at the end of 2022. Originally, you were only allowed to defer until you got PPP forgiveness. Once you got forgiveness, you could still defer what you had already deferred, but you had to stop. And then under the PPP-FA, the Flexibility Act, you were actually told that no, even once your PPP loan is forgiven, you can certainly continue going ahead and deferring your employer's Social Security. So I want to encourage everyone to take advantage of that. Again, it doesn't relieve you of the liability. It's not like, you know, what Congress is talking about in Phase 4 relief in terms of tax holidays or payroll tax holidays. All of that is just talk right now. This does not relieve you of the liability for Social Security, but it defers it so that in terms of cash flow, you have greater access to funds now when you need them. And that amount, of course, has to come out in the wash, has to be reconciled on the 941 here. We're going to see how all those numbers play out. And then the last easier to understand concept, let's put it that way, is the health plan expenses that went along with any sick leave or FMLA leave or employee retention credit wages that you paid. That the provision was that if you kept paying premiums or any other healthcare expenses for your employees who were on FFCRA leave or on retention, you get a credit, dollar for dollar credit for any amounts of the health expenses that you paid. It's offset, just like the wages of FFCRA are offset, so too any health amounts that the employer pays are offset dollar for dollar, not for your entire payroll, but only for those employees who are either on retention or who are getting FFCRA leave, whether it's sick or family leave. Now, those of you with Viventium know that you were able to enter those amounts as a code on your payroll so that they would show up properly on the 941, and you do want to make sure to verify that on your 941. And again, those of you who may not have realized this or weren't aware of this with other providers, may want to consider, if your returns haven't been filed yet, letting your provider know that you're actually entitled to greater credit than was on there and that you can still benefit from this if the returns weren't filed yet. Again, if they were filed, you're going to be in an amendment kind of situation. And right now we're kind of, you know, in between with that. We don't know, we're in limbo. We don't know what's going to be with the amendments, but it's important to know that the concept exists and there is an additional credit that can be used to help, you know, your solvency at this time. Now let's take a look at our two purples on the bottom. Why is the IRS putting first quarter amounts on a second quarter return? So a little bit of history. The CARES Act created the employee retention credit, and I see there was a question for a little bit more of a definition of the employee retention credit. I'll do that in a minute. But it was just for now, whatever it is, put it in a black box. It was created by the CARES Act, which was signed into law on March 27th. March 27th, 3 days before the end of the quarter. Maybe 4 days, if we count March 27th, but whatever it was, close to the end of the quarter. And the provision of the CARES Act said that you can put employees on retention for any payrolls after March 12th, meaning from March 13th and on. The IRS said, we're not doing this. We can't turn on a dime. Physically, we cannot create a new return now for the end of the first quarter that's going to reconcile this amount. And so they told, the guidance said, this will all be reconciled on your second quarter return. And here it is. It's on your second quarter return. By the way, these lines will not be filled out. Lines 24 and 25 will not be filled out in third and fourth quarter. If you forgot to put them on your second quarter return, you're going to have to amend. You're not allowed to use lines 24 and 25, according to IRS guidance. You're not allowed to use them in the third and fourth quarter. So any wages, any employees that you put on retention between March 13th and March 31st, their wages are going to be included as credits, or 50% anyway, are going to be included as credits on your second quarter return. And the IRS, for auditing purposes, wants you to specify what they are. And that's why you have second quarter amounts on this return. Now, I'm getting a little scared by some of the questions that I'm seeing because I think there's some big misconceptions here. So let me pause a minute and answer a couple of these questions. First of all, just definition. What is employee retention? So again, as we mentioned before, just to review, employees that would have liked to work. In other words, they weren't on FFCRA leave, they weren't taking care of a child, they were ready and willing to come to work, and they can't work. They can't even telework because you don't have work for them because of COVID-19 related slowdowns. So if you keep on paying them, then you can put them on retention, meaning you can get a 50% credit for the amounts that you pay them. That's in a nutshell. Again, for further details, I refer you to the Viventium webinars. Now, a question was asked, what about employee retention credit wages? Are they allowed in the computation of the PPP loan? So again, we're getting a drop off track here, but this is such an important misconception that I want to clear it up. If someone has a PPP loan, you cannot have employees on retention, meaning you cannot claim the employee retention credit. Meaning, if you had claimed the employee retention credit, and then you got a PPP loan from the SBA, a Paycheck Protection Program loan, you must go back, void those checks, take those employees off the retention credit. They do not go together. The IRS will not allow employee retention credits together with the PPP loan. Very, very important point. And now we come to a brand new concept. And by the way, thank you all who are asking questions. And there are a couple of questions I haven't answered yet. We'll try to leave some question and answer time at the end if I don't get to them in the course. I see there's been a question about the 7200. That'll be covered as we go on, so just stay tuned. We come now to the brand new concept of a non-refundable credit and a refundable credit. And, you know, to my friends at the IRS, I really give them a tremendous amount of credit for putting together this form, getting everything in. The only, you know, wish I would have had was if they hadn't used this term non-refundable and refundable. I understand why they did it. I'm going to explain to you why they did it, but I just feel those terms are a little bit misleading. Basically, those of you who are familiar with personal tax returns or corporate tax returns, the concept of a non-refundable credit, it's an offset against taxes. And once you finish offsetting your taxes, even if the credit is greater, it's lost. You know, if you had some types of, you know, investment credit, research credits, you can use them to offset, you know, according to state law, according to federal law, various tax liabilities. But if you reduce your tax liability to zero, you're not going to get money back if it's a non-refundable credit. Whereas a refundable credit is the opposite. Perhaps some of you are familiar on your personal tax returns with the additional child care credit. So you know that, you know, you have child care credit, you can use that up to $2,000 per child to offset your tax liability. But what if you offset your tax liability down to zero and you owe no taxes and you still have credit left over? So then there's something called the additional child credit, which is up to basically $1,400 without getting into personal taxes right now. Yesterday was tax day. You get that money back. It's a refundable credit. And there are other credits like that, where if the credit amount exceeds your payroll tax liability, the IRS sends you money back to your pocket. That is the traditional sense of a non-refundable and a refundable credit. Now, the reason I think it's unfortunate that the IRS chose these terms is because the meaning or the implication doesn't really hold through for the 941. A non-refundable credit on the 941 does not mean money that you're going to lose. You're going to get back every cent of your non-refundable credits and every cent of your refundable credits. So then why are they making this distinction? Congress didn't talk about refundable and non-refundable. No IRS guidance talked about refundable and not till they introduced the draft form of the 941 and the instructions. We didn't know anything about non-refundable or refundable. If you look back, if you've been in previous Viventium webinars, if you go to the Viventium VCUC, the Viventium Coronavirus Resource Center, Update Center, you'll find nothing there because the IRS didn't say anything about refundable and non-refundable. This was a surprise. This is a little bit of a bombshell. And it was telling us that there's something new we have to learn here. So of course, in compliance, our whole team dug right in, and I'm going to give you the lowdown now on non-refundable and refundable credits. And to do that, we again need to go back a bit in history. When Congress originally wrote the FFCRA and the CARES Act, they said, any employer who has these credits, what can they do with them? They can use them to offset what? They can use them to offset their employer Social Security deposit. Again, let's repeat that. If you had FFCRA credit or CARES Act credits, you could use those credits to offset your employer Social Security, period, full stop. A few days later, about a week later, the IRS came out with guidance based on these acts, and they said, well, if you have credits under FFCRA or later under CARES Act, you can use them to offset your entire federal tax deposit. And for a few days, we were kind of open-mouthed in the payroll industry. If you remember, we actually talked about this in some of our webinars. What's giving the IRS the right to expand this credit and say you can now offset your credits against your entire payroll tax liability, your withholding tax, your employee Social Security deposit, your Medicare employee, your Medicare employer? Congress only said employer Social Security. Where is the IRS getting the authority to expand this? And then the IRS's explanation was very clear, and I'm going to explain it to you. Think about this a minute. Let's say somebody had $6,000 in employer Social Security tax and $13,000 in FFCRA and CARES credits. Well, so they can offset the $6,000, and then the other $7,000, they're going to have to write a letter. Dear IRS, I have $7,000 in credits. Please mail me a check. Well, instead of a letter, the IRS told us to use Form 7200. Fine. I want $7,000 back. Meanwhile, let's say that same employer has a federal deposit to make because of federal withholding tax and employee Social Security and employee and employer Medicare of $20,000. So what's it going to do? It's going to write a check or do an EFTPS. Dear IRS, here's $20,000. So it's going to send the IRS $20,000, and then the IRS is going to have to mail back how much? $7,000, the remainder of its credits. So the IRS said, isn't that silly? Isn't that just a waste of time? The whole intention of Congress is to give cash flow, to provide ongoing immediate assistance to businesses so that they have the money they need, the access to the funds they need now during the height of the coronavirus. Well, why should we make people deposit all their federal deposit just so that we can mail them back? We'll tell you, employers, go ahead and offset the IRS money that you have in your pocket, what we call trust funds, right, that you usually can't use for anything. You don't want to touch trust funds. But the IRS is now saying, go ahead and use those trust funds against any FFCRA or employee retention credits that you have. If there's any money left, send it to us. And if there's not enough money, even then send in the 7,200 and we'll send you the rest. That's what the IRS did. And here comes the concept of non-refundable and refundable. The portion of your COVID credits that is offsetting the employer Social Security, the Congress portion, the portion that Congress had spoken to, is called the non-refundable credit. And whether or not you collected the whole thing or whether you didn't collect it and you put it on the 7,200, doesn't matter. Collected, uncollected, if it's offsetting employer Social Security, as Congress spoke, that's the non-refundable credit. And the refundable credit is the amount that's applied against everything else, against the employee federal withholding, the employee Social Security, and the employee and employer Medicare. There is no practical difference from a bottom line between your non-refundable and refundable credits. You will get every cent of both of them. However, because of the way the law was written, the IRS is now separating them on the 941, and they're making you separate between the non-refundable credits, that means the amounts that was applied each payroll, the amounts that were used each payroll to offset employer Social Security, and separately the refundable credit, which is the amounts that were used each payroll to offset the rest of your liability. Now, I'm hoping, I don't know if anyone on this call is doing payroll by themselves, preparing their own tax returns. It's tricky. You need to really open up an Excel sheet and work through payroll by payroll, the separation of the non-refundable and refundable portion. Those of you who are with providers, again, those of you who are with Viventium, you have it done. You're fine. Viventium is doing this for you. Matter of fact, there was a question, I'm a Viventium client, do you file the 941 for us? Well, the answer there is it depends if you're on tax service or not. Viventium clients who are also using Viventium tax service, we're doing the filing for you. If you're not using Viventium tax service, then we send you the form and you just have to fill in the information that you know, which is the amount of your deposits, to complete it and to file it yourself. But that is the difference between the refundable and non-refundables. And again, those of you who are not with Viventium, as a best practice, review your forms, speak to your providers, make sure that they are correctly dividing up on a payroll by payroll basis the refundable and non-refundables of the credits. And now we're ready to go line by line through this form, now that we finished our dictionary. And I know someone had asked, is there a slide to see the new 941 concepts? Well, here it is. Now we're going to zoom in. I'm going to zoom in with you on my screen to make it a little bit easier to view. And okay, as we set up on the top, January, February, March are grayed out. Don't even try, don't even think of checking for our first quarter here. The first two lines should look very familiar to us. It's the number of employees paid on payroll that includes June 12th. That has not changed. That's statistical BLS purposes, Bureau of Labor Statistics. And line 2, wages, tips, and other compensation, that's also the same definition as before. And the federal income tax is also the same thing. So lines 1, 2, and 3 have not changed. Taxable Social Security wages. So right now you're all with me. You know that that definition has changed. That is your taxable Social Security wages, but not including FFCRA wages. You put that in column 1, you multiply it by 12.4%, and you get to your Social Security tax on column 2. Lines 5AI and II, those are the new lines. That's where you're putting down your qualified sick leave, whether it's sick self or sick other, any of those 6 reasons under FFCRA, and your qualified family leave, that's the emergency FMLA, or sometimes called child care leave, the 10 weeks, that goes on line 5AII. Why? Why is the IRS doing this? Why do they say don't include it in taxable Social Security wages? The answer is, look at what you're multiplying it by. You're only multiplying it by 6.2%, not the full 12.4. Why is that? Well, the answer is because FFCRA paid wages, all this disability and paid or sick, all of this is not subject to employer Social Security. That was part of the provision of the law. It's only subject to employee Social Security, and therefore it's only multiplied by half, by 6.2. So for one of the first times in history, not the first time, but one of the only times, the definition of employee Social Security wages and employer Social Security wages are different. The amounts are not going to be the same. Like when you look down at Social Security tips, taxable Medicare wages, those of you who are used to seeing that your Social Security and your Medicare are the same on your 941, because you don't have employees who cross the limits, you're not going to, but if you had FFCRA leave, you're not going to see that this quarter. You're going to see that your taxable Social Security wages are lower than your taxable Medicare, because the taxable Social Security that is subject to both sides does not include FFCRA wage. FFCRA wage is only subject to employee Social Security. Now we're going to talk about at the very end how this can actually give you an overpayment situation on your 941 that the IRS didn't even realize. In a phone conversation with stakeholders of the payroll industry, the large payroll processors, the IRS has a phone conversation with the industry once a month. In their June 11th phone conversation, they explained that there was something that's not in the instructions, not in any of the guidance. I'm not sure that they realized it till they, actually saw what was happening on their form. But there can be a situation where employees cross the Social Security wage limit and employers don't, and that can result in an overpayment. And we're going to talk about that at the very end. But right now, I just want to finish going through line by line. So we got down to the bottom, line 5E is total Social Security and Medicare tax. Then we have some notice and demands, adjustments, fraction of cents, that's all standard, that's all familiar. But then we get down to lines 11B and 11C, which are brand new, and that's the non-refundable portion. Now we understand what that means. The amount of the credit for FFCRA sick and FFCRA family leave, that's non-refundable. And this again has to be done on a payroll by payroll basis. This is the amount each payroll that you offset only against your employer's Social Security, only what Congress spoke. And similarly, the non-refundable portion of your retention credit. Now, there's actually a worksheet in the instructions. So those of you who want to figure this out on your own can go to those instructions and fill out the worksheet just to check your service provider, make sure it's correct. But the non-refundable portion of the retention credit is the same thing. It's the amount of the CARES retention credit that was used only against the employer Social Security. Okay, that was page 1 of the form. Now page 2. The entire part 1 is new, practically. Let's take a look at it. So they want you to total up these non-refundable credits. That includes the CARES amounts and the FFCRA amounts, meaning the retention credit plus the sick and family leave. And that amount gets subtracted, because those are credits, that gets subtracted from your total taxes and is put on line 12. Best practice, as soon as you get your packet from your payroll tax service, open up to line 12, open up your Schedule B. the bottom line on Schedule B must equal line 12. With Viventium, it will, of course. But if you see that it doesn't, pick up your phone and call your provider. Or if you're using off-the-shelf software and you got some type of a patch or an update for COVID, if it doesn't match, don't file that return. Line 12 must balance with your Schedule B, or if you're a monthly filer, it must match this, your total liability for the quarter. They even tell you that total must equal line 12. Why am I putting so much emphasis? It always has to balance, that's right. But the difference this quarter is that your Schedule B, week by week, payroll by payroll, had to have the non-refundable credits subtracted out of the weekly liability. And the same thing if you're doing it monthly. Each month had to have not the refundable portions, but only the non-refundable portions subtracted out. And that's why these amounts must match line 12. Very important point, very important quality assurance to check that on your returns. This is all brand new to everybody. So, you know, if you know, homegrown software made mistakes, or if, you know, I'm not, you know, placing blame on anybody, but I'm just telling you as an employer, your concern is to make sure that line 12, your liability balances, because that's going to be an automatic reject or an automatic audit or an automatic correspondence with the IRS, automatic headaches. Line 12 must balance if you're monthly depositors down here, your total liability, and if you're semi-weekly, it must balance to your Schedule B. Okay, so now we get to total deposits for the quarter. That's the amount that you actually paid in after all this with your EFTPS or however your tax service deposits for you. And then line 13B, here's another one of our concepts from our dictionary, deferred amount of the employer's Social Security tax. So any amount you chose not to deposit because you're deferring till 2021 or 2022, that has to go here on 13B. Again, you're going to want to be verifying this number. And then you're going to put down the refundable portions of both the FFCRA and the retention credits. Those are the amounts that got applied against all your other deposits, not your employer's Social Security. And then you add it all up, the deposits and the deferrals and the refundable credits. And that's the amount that you paid in, or you did the equivalent of paying in. You either paid in or you deferred or you had credits for. From that, you must subtract any advances that you got from the IRS on your Form 7200, and that gets you down to your total deposits, deferrals, and credits, less advances. And that's the amount that you're going to compare to line 12 and see if there's a balance due or not. Now, lest you think that we're finished because we got down to a balance due or a refund, we still have page 3. If you forget to fill out page 3, again, automatic correspondence, automatic filing issues with the IRS. Don't forget to fill out page 3. Here you have to tell the IRS how much of that qualified sick leave credit that you took, refundable and non-refundable, how much was due to health plan expenses if you continued paying the health insurance, and how much of the family leave wage credit was due to health plan expenses. Tell us so that we can audit you. This is disclosure. This is not going into the calculation, but you must disclose, and it must be appropriate because they may check up on you. And qualified wages, what were the wages for the retention credit? Remember we said that you can get a 50% credit for the payroll paid to employees on retention? Well, they want to know how much did you pay to your employees on retention so that we can check up on you later, make sure the amounts are accurate. And then again, how much health care was included in the employee retention credit that you claimed back online earlier on the form. And then of course you have the first quarter, how much retention wages were paid in first quarter and how much health care was associated with those retention wages. Okay, so that was our step-by-step through the form. Well, we got through that. Now, as I mentioned before, very important misconception. You may have filed Form 7200s during the quarter, and I've been seeing questions about the 7200s. And some of you have asked if Viventium file 7200s. No, that's up to the employer to decide if they want to ask for an advance from the IRS or not. You're still going to get the money. Even if you never filed a 7200, you will get all the credits that you are entitled to. Don't worry about that. But if you wanted it earlier for cash flow purposes, you were allowed to send in a 7200 with each payroll if you wanted. You could just keep on faxing them. And based on the surveys that we sent out to collect data from our clients, many clients have actually benefited and received credits in advance. So what am I supposed to do now? Am I supposed to take the amount from line 8, which was total advances requested, total them up of all my forms, my first form, my second form, however many 7200s, and put it over here on line 13F. Well, let's zoom in. What does 13F say? Total advances received from filing 7200s? No, that is not what we want to be doing. That's a big no-no. And if you're doing this on your own, or if you're comparing this to your payroll service, you want to make sure your line 13F is not, big red X, is not the total of the line 8s from your 7200s, because those are only the advances that you requested, that you faxed to that room where the IRS was keeping its fax machine. And they apparently were actually retrieving their pages because they mailed checks out. And again, kudos to the IRS for a job well done in getting that money out. So then what am I supposed to put on line 13F? Exactly what it says. The total advances received from filing the 7200s. Only the checks received. Now, those of you who are with Viventium, you know that we had sent out a survey to ask you for the amounts received. If you went through and added up your 7200s and put that on, you're going to need to get in touch with us right away and probably be in an amended situation, because I believe it's already too late to redo your forms. That was not the instructions. That's not what you should have put there. And those of you who have been doing this on your own or with other providers, no, no, no. It's not the totals of your 7200s. It's the totals, and this was hopefully clear in the survey that we sent out, but you know, some people may have missed it. It was the amount that you received, actual physically received in terms of checks. There was no electronic, the IRS mailed checks, the checks that you received from the IRS. And that's what you put here. And that gets subtracted out of the credits and advances that you are claiming. Now, someone actually asked a question and they said, what if, and this is a 7200 question, what if I sent in the form 7200, but the IRS said a name was incorrect, an officer's name was incorrect, and we refiled? What do I do now? Well, you don't have to worry, because anyway, you're going to get the money on your 941. Everything comes out in the wash, as Willy Wonka, I think, would have said. Everything gets reconciled on Form 941. The 7200 was simply a way of getting the money faster. Now, I thought you were going to ask me a different question. What if my provider, or I file my 941, you know, it's in, and then I get a check for one of my old 7200s? Or what if I got a check now after I told Viventium how much I got? What if I get another check now? What am I supposed to do? Am I supposed to tear up the check? Am I supposed to deposit it? Am I supposed? Well, the answer is ask your CPA. Probably what you're going to hear from your CPA is, we don't know yet, because the IRS has not spoken about that yet. That's, again, they will get around to it. I'm sure they will. But right now, as I said, they were putting all their resources just into getting the form ready. And so they have not explained what to do if you receive a 7200 check after you've already filed a 941, or after your service is closed, you know, your 941s, you can't change it. And that check was not included on line 13F. So that's an open question. But what's clear is, as we state down here on the box, do not report the total of line 8 on the 941. Instead, do report the checks received from filing the 7200. And now, with the remaining 10 minutes or so of our webinar, we are going to do a case study. And I did tell you that I was also going to tell you what the IRS realized in their June 11th phone call, so we'll leave some time for that as well. Fictional company, Helpers from the Heart, an Oklahoma-based home health agency, 400 employees. They process payroll. Now, why are all these colors here? Because we're soon going to look at their check register. Just a sneak preview. Let's slide over there. Here's their check register. See all the nice colors? We're going to actually tie in the scenario to the check register, and then later to the 941. I personally think these next 3 slides are the most important of the whole payroll, of the whole webinar. As soon as you get the slides, when you'll be getting a copy afterwards, print these out. You know, tape them up on your wall. Use these as a check of your own situation, because this is really, it's not till you talk, when a webinar is so hands-on, so technical, you need numbers. That's really the way to understand it. Okay, so Helpers processes a monthly payroll, no pre-tax deductions, keep it simple, and they are only a monthly depositor, not a semi-weekly, for federal payroll tax liabilities. Great. Now, on March 10th, they were suffering a slowdown due to COVID-19, so they laid off 10 home health aides. Each one earned $3,000 a month, but they continued to pay them their full salary through the end of the second quarter. So right away, bing, 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 light goes off. These employees are eligible for retention, which means the employer is eligible for a retention credit of half of what they paid. So it's a $1,500 credit per employee per month. up to $10,000. Well, we didn't pay more than $10,000 to any one employee, so we're good. That'll be a retention credit. They also elected to defer their Social Security deposits, but only those due in April, May, and June. In the second quarter, they didn't really understand COVID credits completely, which is most of us, and so they deposited taxes only equal to their federal withholding. They figured that at least that they wanted to deposit, but they weren't sure if they should deposit anything else. They did file 7,200 twice, but as of the date of their 941 filing, they only got credits from their first filing. And then on July 6th, they heard that President Trump had signed an extension of the PPP program on July 4th, and they decided that it was time to send in an application for a loan to the SBA, and they did. But as of the date of filing their 941, they were not yet approved by their bank. Well, since they were not yet approved for the loan, they can still take the employer retention credit. If they had been approved, they would have to go back and redo their payrolls to cancel the employer retention credit. Okay, so let's see how this plays out in their check stub. So we see their period ends on the 8th of every month, and I purposely included a month its first quarter. And we'll soon see why. And then their check date is 4 days later on the 12th of the month, and their gross for every payroll was $100,000. Their federal withholding was $5,000 a payroll. And then you can do the multiplication yourself. Employee Social Security is always 6.2% times the gross. Employer Social Security during the first quarter was 6.2% times the gross. That's why it's 6,200. But during the second quarter, it was less because the amounts that they paid in FFCRA sick and FFCRA child, in other words, the amount that they were mandated from April 1st on to pay for people who went out on FFCRA leave, are not included in employer Social Security. They're exempt from employer Social Security. So that's $200 a month. If you take your 6,200, if you take your 100,000 and you subtract that $200 paid for FFCRA leave, both the sick and the child are both FFCRA leave, right? So that's going to reduce your Social Security employer wages and slightly lower than your employee. Medicare EE and ER are the same. That's 1.45% of your 100,000. And they did not pay any FFCRA leave in March because FFCRA leave was only obligatory in April. And if you jumped on the bandwagon early because the law had been signed and you started to pay it in March, you can't count it toward your obligation. The DOL had specified only from April 1st and on. Now here's a retention credit. Remember they had 10 employees and $3,000 wages. Anyway, the retention credit each month was $15,000. It was $1,500 per employee times 10 employees, $15,000 retention credit. Again, that only kicked in from April 1st and on. Why can't they count the wages that they paid in March? I thought we said that because the check date was March 12th. And the employee retention credit only applies to first quarter if it was for payrolls on March 13th, after March 12th. So our case situation is pretty easy, pretty straightforward, no first quarter wages. Okay, their total credits are the amounts of their FF sick, plus FF child, plus employer retention, plus the employer Medicare on these $200. That's why there's an extra $290 in there. In other words, it's the $200 plus the $15,000, and the credit includes, and again, Viventium does this for you automatically. If you're not with Viventium, follow up with your provider if they're providing this, or do the Schedule I worksheet yourself. But any employer Medicare paid on FFCRA leave, that's 200 times 1.45% is 290, is also a credit. Of that, how much is non-refundable and how much is refundable? Well, the non-refundable is the amount of the Social Security of the employer. That's the non-remember by definition. That was the, I'm sorry about that. That by definition was the refundable amount, $6,187.60. That's going to go for non-refundable. The refundable is everything else. It's the 15,202 minus the 6,187. You do the math, you'll see it. Now we said in our assumptions, you go back to the pink over here. What did they deposit? They only deposited federal withholding because that's what they understood. So they only took their $5,000 each month and deposited that. They also deferred, let's look back to our light pink. What does it say here that they deferred? Their April, May, and June deposits. Okay, remember they're a monthly filer. So that means they deferred their March amount, their March Social Security, because that's due April 15th. They deferred their April amount because that's due May 15th, they deferred their May amount because that's due June 15th. They did not defer their June amount because they decided to. That was your decision, what you defer and what you don't defer. It's entirely up to you or your accountant. So there's 0 for the amount that was due July 15th. Now note that even though this first $6,200 belonged to a first quarter payroll, they were allowed to defer it because any liability after March 26, that's the way the law was written, any liability after March 26 could be deferred. And they had filed the 7,200 twice. Let's go back to our light purple. They filed 2 forms 7,200, but they only received credit from 1. So they asked for 8,000 and they only got 4,000. Okay, now let's do the 941. Note all these amounts in color at the bottom. They are going to tie in to our 941. And here it is. We're going to zoom in to see it a little bit bigger. Here's helpers 941. First, let's move over to the first page. Okay, so their name, information, checked off second quarter. They had only 350 employees in June because they had laid off 50. And their total payroll, well, it was 300,000, right? If we look back, let's go back to our previous slide. It was 100,000 every month. So the total was 300,000. There we go. 300,000 right here on the form. Okay, their federal tax is 15,000. That's right here. And we have it over here on our form as well. Now, here comes the hard stuff. Taxable Social Security wages. Well, Medicare wages are the same 300,000. Why is taxable Social Security only $299,400? Because remember, the 300, they paid 100 each month in sick and 100 each month in family leave. That's not included, as we said before, that's not included in our taxable Social Security. So taxable Social Security wage is only $299,400. That's what gets multiplied by both shares. The 300 in family and sick wages only gets multiplied by half, only by 6.2, because it is not subject to employer Social Security. And of course, Medicare is subject to both. That gives us our total taxes of some $45,000. We add that to our $15,000 of federal for total tax of $60,000. A little bit of a fraction of cents there because I'm rounding off the zeros just to make it easy. So our total taxes are $60,863. That's before credits. Now, what about the non-refundable qualified sick leave? Let's look back to our payroll check register. And it was only $600. And the entire employee retention was $45,000. If we do the calculation, the amount that was used to offset the the employer Social Security was only $18,562. Now, once again, to stress, just because it's called non-refundable doesn't mean they're not getting it back. They're getting full credit for every last red cent of it. They're getting full credit. It just has to be broken down separately, payroll by payroll. And so, let's skip to our next slide. There it is, the $18,563 as the refundable. Now we move over to page 2. Total non-refundable credits, that's carryover because there was no others. There's both the employee retention and the FFCRA. Here it's all in employee retention. And then the total taxes is now reduced. Instead of being some $60,863, it's now only $42,000. This is the number, big flashing red, yellow lights. This number must balance to the Schedule B. Okay. Then what were the deposits for the quarter? Well, let's look back on our little pink over here. How much did they, remember we said they didn't really understand, so they only deposited the federal withholding. That's fine, no problem. You can get away with a lot this quarter because of all the credits. Okay, so you have here your total deposits, 15,000. And then the amount of the deferral, they were entitled to defer Social Security. That we also pulled from the register over here in yellow. So the reason this is great that it's color coded is that we can refer to it. Now note, this is not the second quarter total. When it comes to deferrals, you can reach back to any amounts that were deferred even from first quarter payrolls, as long as they were for liabilities after March 26. Very important distinction. That's why I purposely included that first quarter. So you can see how, when you reconcile, sometimes you need to reach back to the first quarter if you indeed deferred liabilities that were due after March 26. Everyone has to know their own situation. It's not going to necessarily apply. Those amounts, meaning the deposits and the deferrals, And the refundable credits, that's what everything that's left after that 18,000 of non-refundable, all that is what you get credit for, 60,000, except for the amounts that you actually received on your 7,200. So never mind that they asked for 8,000, they only received 4,000. So it's only the 4,000 that gets subtracted out. What's going to happen when they get that next $4,000 check a day after they file their return? I don't know. Put it aside, ask your CPA, or just hold tight till there's IRS guidance. So you don't get the full credit for the full 60,000 because the IRS already gave you 4,000 of it. So you get credit for 56,621. And when you compare that to your tax liability, you see, oh, you are overpaid, and you ask for an overpayment as a refund. And again, this is why I said it doesn't matter. Even if you didn't file a 7,200, you're still going to get your credits. It's all going to come out in the wash. It all gets reconciled. And we're still not done because we need to do the informational. If you file without this, your return will be considered incomplete. Were there any health plan expenses? No, we didn't say that in our scenario, no health plan. However, there were wages paid for the employee retention credit, and that needs to be filled in. And that is what gets put on the last page of the 941. Okay, that is our case study. Let's back out. And before I conclude, I just want to, and we're really in our last few minutes, I want to explain what the IRS told industry stakeholders on June 11th. Don't you wish you were on that phone call? If an employee crosses the Social Security limit during the quarter, if any of you have employees who earned more than $127,700 this quarter, usually the employee and the employer shares cross the limit at the same time because the definition is the same. But starting this quarter, the definition of employee and employer credits are not the same. Employer Social Security and employee Social Security wages are not the same thing. Employee Social Security wages include FFCRA payments. Employer Social Security wages do not include FFCRA payments because FFCRA payments are exempt from employer Social Security. That means it's entirely conceivable, and we've had this for a number of Viventium clients, it's entirely conceivable that employee Social Security will max out, but the employer share is still going to be getting calculated because they haven't crossed the limit yet. Now, the IRS apparently, I'm not sure if they really realized this because they didn't include this in their instructions, but the question was asked on this June 11th phone call, and you know what the IRS said? Really mind-boggling. You know what they said? They said, if the employee's share of Social Security wages has crossed the limit, then make the employer's share cross the limit also, and don't pay that additional tax. Now, that was really a bombshell because in essence, what they're saying is, just like you get a credit for Medicare, employer Medicare paid on FFCRA, we're also going to give you a credit for employer Social Security paid. In other words, you only pay employer Social Security until the employee crosses the limit. Even if the employer hasn't crossed the limit yet, you're just going to stop paying Social Security. Now, since they didn't tell us that at the beginning of the quarter, and they couldn't because they probably didn't realize it themselves, employers may find themselves overpaid. And those of you who are with Viventium will have a refund calculated on your return. Those of you who are in this situation, who had employees who reached the $127,700 wage base in the second quarter and are not with Viventium, as a best practice, please do reach out to your payroll service provider or your software, off-the-shelf providers, if they give you a patch or a fix or an update, and ask them, I had employees that crossed the limit. Are you getting me that refund that I'm entitled to because of what the IRS said in their June 11th phone call? And that means we're pretty much out of time. We're even a bit over time now. And so sorry, I'm not going to be able to answer too many more of your questions. Although those of you who are Viventium clients, and really everyone, can feel free to reach out to me directly. You can either visit the Viventium.com website or our VCUC, that's again the Viventium Coronavirus Update Center, or reach out to me directly. My name again is Yonina Shineweather. My email address is yshineweather, my first initial Y, and my last name Shineweather, spelled exactly as it sounds, SHINEWEATHER, that's yshineweather@Viventium.com. And I wish you all accurate and correct 941s and the ability to get as many credits as you are entitled to, overpayments, refunds, and the ability to understand what's going on your new 941. Thank you all very much for your attention today, and have a great afternoon.